point in the day. Well, you know, the summer months can certainly be a tough time for investors on Wall Street, and we may still hear that screaming. But one thing that plays into it all, human behavior. So how much does word of mouth in the street play into just how people invest their money? It's an interesting topic, and here to talk about it, Dennis Fagan from Fagan Associates. And Dennis, this is an interesting thing because I think we think that everybody is making very educated and researched decisions about their money, but I wonder if some of that research isn't just what somebody else has suggested.
Well, it's funny that with everybody now really having access to their accounts through the computer, different personality traits enter into decision making. A lot of people have, and we study this a lot at our company just because of the inconsistencies and really opportunities it creates for us investors. And one is like you have a personality trait. People with mortgage rates at 2 or 3% still want to pay off their mortgage. Everybody has their own financial personality. They also have their own personality traits like stubbornness, things like that cause them to hold on to a stock no matter what it's doing. And then there's a glitch in the way that we think that causes us to really come to the wrong conclusions. For instance, if we like a stock, we'll give a lot more emphasis or confirmation to analysts that agree with us versus those that disagree with us. So what happens is that you tend to listen to the people that agree with you, give less credence to those that don't, and then that causes the investor to make poor decisions and sometimes hang on to those poor decisions. So, you know, a disciplined approach to investing really can help overcome those inadequacies in our way of thinking.
You know, it's interesting, as you were describing those personality traits, I was thinking to myself that I bet casinos would also look at those same kind of personality traits where you hold on to something or you stay at a machine because you think it's going to pay off eventually or something like that. Do you have a hard time persuading people then otherwise?
Well, it's called like the gambler's fallacy, the belief that if you're playing roulette and there's 5 reds in a row, that black has to come up. And statistically, there's no coincidence, or there's no kind of attachment between those two potential events. So you see that all the time, or the belief that, well, G went from 60 to 50, so now it's a better buy, and then 40 and 30. And so people tend to hang on to their investments. So the minute you buy a stock or a mutual fund, you need to have discipline that says, if this happens, I'm going to sell it. And you have to adhere to those, or else your emotions and hope tends to get in the way of logical decision making.
And just quickly, does it play a big role in what happens with the market, do you think? These kinds of decision making based on personality?
Definitely on a shorter term basis. For instance, if a company comes out with bad news overnight, the first 15 minutes you're going to see selling, period, and that creates opportunity for those that think it's a long-term buy.
Boy, that's fascinating stuff. Yeah, it really is. Thank you for our little psychology lesson for the day. Dennis Fagan from Fagan Associates, and we'll look forward to seeing you again soon. Well, there were some storms out there today. We're going to go right over to meteorologist Craig Adams.